Most people think the Federal Reserve prints money because it wants to stimulate the economy. But that's not actually true. In reality, the system the Fed operates in forces it to keep providing liquidity, even when it tries to stop. Because modern financial markets depend on liquidity, a constant flow of it. And once that system grows large enough, stopping liquidity becomes dangerous. In fact, it creates a trap the Federal Reserve can't easily escape. So the real question isn't whether the Fed will stop printing money. The real question is, why can't it? So if markets depend on liquidity to function, what actually breaks when liquidity disappears? The answer lies in a part of the financial system most people never see. Modern markets are not just places where stocks, bonds, or other assets trade. They are part of a massive, global funding system. Every day, banks borrow, hedge funds borrow, pension funds borrow, corporations borrow. Together, they move trillions of dollars every day. And at the center of all this are short-term funding markets. These funding markets help institutions finance everything from government bonds to corporate assets. But these markets only work when liquidity is abundant. Because when liquidity disappears, borrowing costs spike, markets freeze, and institutions that rely on short-term funding suddenly lose access to financing. This is what happened during the 2008 financial crisis, and again in March of 2020. In both cases, liquidity disappeared faster than markets could adjust, and the entire system began to cascade. To see how powerful this system is, we can look at what happened in March of 2020. At the beginning of the pandemic, financial markets suddenly faced extreme uncertainty. Investors around the world began selling assets and moving into cash. Normally, the US Treasury market is one of the most liquid markets in the world. But during those weeks, even the Treasury market began to break down. Dealers struggled to absorb the wave of selling. Bid-ask spreads widened. Liquidity across funding markets began to evaporate. The system was starting to seize up. And when liquidity disappears in the world's most important bond market, the consequences can spread extremely quickly. So the Federal Reserve stepped in. It began purchasing massive quantities of Treasury securities. It launched emergency lending programs, and it injected trillions of dollars of liquidity into financial markets. Within weeks, the Fed's balance sheet expanded dramatically. Funding markets stabilized, and the cascade stopped. This moment revealed something important. When liquidity disappears, the entire financial system can begin to break down. And when that happens, the Federal Reserve becomes the system's ultimate backstop. Now, is this actually a good thing? Let's find out. The Fed is not just responsible for controlling inflation and unemployment. Its deeper role is to act as a backstop for the financial system. When liquidity disappears, the Fed injects liquidity back into the system. It does this by purchasing assets, providing loans, and expanding its balance sheet. This stabilizes funding markets and prevents the financial system from collapsing. But this also creates a powerful feedback loop, because markets eventually begin to depend on that liquidity support. And this is where the trap appears. When financial markets grow large enough, liquidity support stops being temporary. It becomes structural. Debt levels increase, asset prices rise. And financial institutions begin building strategies that assume liquidity will always be available. Which means removing liquidity suddenly becomes dangerous. Because when liquidity disappears, markets don't slowly adjust. They cascade quickly. And when that cascade begins, the Fed is forced to intervene again. So the real question isn't whether the Fed will print money. The real question is how large the liquidity system will grow. Because the larger the system becomes, the more liquidity it requires to function. And the harder it becomes to remove that liquidity without triggering instability. Which means the Federal Reserve isn't just managing inflation. It's managing the stability of a system that now depends on constant liquidity. If you want more structured macro breakdowns like this, consider subscribing.